A couple in Sydney sits at their kitchen table. 2 incomes, stable jobs, no luxury lifestyle, and yet every month feels tighter. Not because they're spending more, but because something invisible is quietly eating their future: interest. This is the uncomfortable truth about Australia. On the surface, it looks like one of the richest, most stable economies in the world. High wages, strong banks, growing cities. But underneath that image, there's a system running on debt, and not just a little, a lot. This matters right now because Australia isn't facing a loud crisis. There's no sudden collapse, no dramatic headlines every day. What's happening is quieter, slower, and in some ways more dangerous because the system still looks like it's working until it doesn't. To understand this, you have to forget the usual idea of debt. This isn't just about government borrowing. In Australia, the real story is household debt. Regular people, mortgages, credit, everyday life financed by future income. And here's the scale of it. Australian households owe roughly twice as much as they earn in a year. Let that sink in. For every dollar they make, they owe about 2. That's one of the highest levels in the world. Now, on its own, debt isn't a problem. In fact, it's how modern economies grow. You borrow, you invest, you earn more later. That's the idea. But Australia took that idea and pushed it very far. Because for years, there was one belief that made everything feel safe. Property prices always go up. Houses weren't just places to live. They became financial engines. You buy a house, it increases in value. You borrow against that value. You invest again. Repeat. It felt like a loop that couldn't break. And for a long time, it didn't. Low interest rates made borrowing cheap. Banks were willing to lend. Demand kept rising. Prices kept climbing. Everyone looked smarter than they actually were. There's a quiet irony here. The system rewarded the people who took on the most debt. The bigger the loan, the bigger the gain, at least on paper. Because rising house prices made everyone feel richer, even if nothing real had changed. No new productivity, no new innovation, just higher asset prices. Now here's where things get uncomfortable. That entire system depends on one fragile condition: cheap money. Because when interest rates are low, debt feels manageable, payments are small, risk feels distant. But when rates rise, the math changes instantly. And that's exactly what happened. Inflation started rising globally. Central banks reacted. Interest rates went up fast. And suddenly, millions of Australian households found themselves in a different reality. Same loan, higher repayments, sometimes dramatically higher. Imagine borrowing at 2% and then paying 6%. That difference isn't theoretical. It's your monthly life. Groceries, rent, savings, all squeezed by one thing: debt becoming more expensive. Now zoom out. If a few people struggle, it's personal. If millions struggle at the same time, it becomes economic. Spending slows down. Businesses feel it. Growth weakens. But the debt doesn't disappear. It just sits there, demanding to be paid. This is where the hidden mechanism reveals itself. Australia's economy isn't just supported by debt, it's dependent on it. Because when people borrow, they spend. When they spend, the economy grows. So for years, growth wasn't just about productivity, it was about borrowing capacity. The more people could borrow, the more the economy expanded. But that creates a problem, because debt pulls demand from the future into the present. You're spending tomorrow's money today, which means at some point, tomorrow arrives, and the bill comes with it. Now layer another reality on top. Australia's economy is heavily tied to housing, not just socially, financially. Banks are deeply exposed to mortgages. A large portion of their balance sheets is tied to home loans, which means if households struggle, banks don't stay untouched. And if banks tighten lending to protect themselves, the entire system slows down. Less borrowing, less spending, less growth. It becomes a feedback loop, but in reverse. And here's where the illusion starts to crack. For years, rising property prices made the system look stable, strong even. But those prices weren't just driven by fundamentals. They were fueled by credit, easy loans, high leverage, confidence. So what happens if that confidence weakens? Not collapses, just weakens. Fewer buyers, more caution, inflation, slower price growth, or even declines. Suddenly, the same debt that once felt like an asset starts to feel like a weight. Because debt doesn't adjust with the market. Your loan stays the same, even if your house value doesn't. Now think about the psychology. When people feel richer, they spend more. When they feel uncertain, they pull back. And when millions of people pull back at once, the economy feels it immediately. This is the quiet tension building inside Australia. On one side, you have a system that needs debt to keep growing. On the other, households already stretched by that same debt. There's not much room left. And here's the subtle but critical detail. This isn't a sudden crisis. There's no single breaking point. It's a pressure system, slow, persistent, almost invisible day to day. But over time, it reshapes behavior. People delay purchases, avoid new loans, focus on survival instead of growth. And when that shift happens at scale, the economy changes. Now add one more layer. Australia's growth has also relied heavily on external factors, commodity exports, global demand, particularly from major trading partners, which means the domestic debt story isn't isolated. It's connected to the global economy. If external demand slows and domestic consumers are already stretched, where does the growth come from? That's the question no one answers directly. Instead, the narrative stays optimistic, strong fundamentals, resilient economy, stable banking system. And to be fair, those things are still partly true. Australia isn't collapsing. Banks are still functioning. People are still paying their loans. But stability doesn't mean safety. Sometimes it just means the system hasn't been fully tested yet. Because the real risk isn't that everything breaks overnight. It's that the system becomes less flexible, less responsive, more fragile over time, until one shock, not necessarily big, exposes how tight everything has become. And by then, there's not much room left to adjust. So here's the uncomfortable thought to sit with. Australia didn't build its economy purely on productivity or innovation. A large part of it was built on rising asset prices, funded by increasing debt. That worked beautifully in a world of low interest rates and growing confidence, but the world has changed. Money is no longer cheap. Confidence is no longer automatic, and debt is no longer invisible. So the question isn't whether Australia has a debt problem. It clearly does. The real question is something more subtle. Can an economy built on borrowing keep growing when borrowing becomes harder? Or does it slowly turn inward, balancing yesterday's growth with tomorrow's constraints? And if that balance tips even slightly the wrong way, what unravels first? The housing market, the banks, or the belief that this system was stable all along?